Good morning. It's February 5th, and we're getting ready to start what appears to be another exciting week of trading. Last week, there was fireworks going on in many of the markets, and if you recall from my What's Up Monday from last week, I started raising the caution flag. Oil was overbought, equities were overbought, the dollar was oversold, and the potential for a correction was certainly rising. And actually, the best way to describe last week was pretty much a week of corrections. Equities got pounded. In fact, they're starting out this week also lower again. Oil has been drifting lower, and the dollar kind of ended the week a little bit higher after correcting this morning. It's kind of trading either side of unchanged. That's the dollar index. So. With that, let's get to some of the details and see where we're going this week. Uh, First of all, we saw that we're going to talk about rather the price direction. We'll talk a bit about the correction. We'll talk about what's happening on the fundamental side. We got some of the monthly forecasts from the three big agencies: the Energy Information Administration (EIA), the International Energy Agency, the IEA, and OPEC. And that'll kick off starting tomorrow with the EIA. We'll take a look at inventories, and as I talked about last week, we may be starting to see the beginning of a transition in the overall inventory destocking pattern, and I think that may continue to transition again this week. I'll give you a little update on how I'm looking at the OPEC Accord. Again, the weather, it's been a very difficult winter for heating oil, natural gas, propane bulls, or heating fuel bulls. As we're going to see from this forecast, we're getting another change in the latest weather forecast that was issued on Sunday afternoon. And we'll also mention what's happening on the geopolitical side. So let's start with prices. What we're seeing is oil prices, again, starting on the defensive this morning. As of about 5 to 8 or so Eastern time, we're off 50, 60 cents for WTI. We're off a bit more for Brent. The April Brent WTI spread is continuing to narrow, and we'll talk about what implications that might have going down the road, because that's one of our gauges as looking at the export economics of U.S. crude oil. Refined products are on the defensive. The March ultra low sulfur diesel contract falling a little bit faster than the RBOB contract. And again, that's principally weather related that's impacting it. Although we're talking about oil, natural gas is also starting the week on the defensive and well below that $3 an MMBTU psychological price that we saw about a week or so ago when it looked like we were going to have another lasting cold spell. As I mentioned, the Dow futures are starting lower. Most of the international equity markets were lower overnight, and Europe being lower. So this is portraying a decline when the Dow index actually opens up at 9:30 a.m. Eastern time. The euro's a little bit weaker, the yen's a little bit stronger, the dollar index is a little bit stronger. Really not much to talk about here so far this morning. It's almost safe to say they're all trading either side of unchanged right now. Looking at a little bit more detailed snapshot of prices, we can see that even with oil correcting, the oil market is still in a backwardation compared to the 12-month forward curve. But now we're trading below the year-to-date average. So a little bit concerning on the short term. I'm not quite sure I would say that the medium longer term uptrend has changed, but I believe we certainly could start seeing some additional downside movements. I think we've done some damage from a technical perspective. The Brent WTI spread is clearly on the defensive, and that's certainly not very positive for exporting crude oil. It wasn't too long ago when that spread was trading over $6 a barrel, about 6.20, 6.30 a barrel, if I'm not mistaken, and that was at the end of 2017. Again, products, much like crude oil, trading below last year, slight backwardation compared to the 5-year average. Crack spreads on the defensive, as we'll see some charts in a little bit, and the intercommodity spreads, the oil to gas, certainly not very exciting right now because of the changing weather conditions. So let's look at crude oil. I mean, we could see medium term, we're still in this upward linear regression channel. We are now, for the March WTI contract, trading below the linear regression line and kind of hovering near the linear regression line -1 standard deviation. It's going to be critical to see if we hold here. If we do hold here, we certainly could then see a resumption in the upward move in prices. When we look at some of the technicals, the directional movement index is coming down. The MACD, moving average convergence, divergences, these are both suggesting further technical correction to the downside. But on the positive side, we see the RSI has now come off of the highs up near the 80s hit just about a week or so ago. So that's a positive. Some of the length, some of the long side traders seem to have gone through the sidelines as of last week. So let's look at some more charts here on crude. We know now the spot Brent contract is the April contract, so I wanted to put both the WTI and the Brent contract side by side. And you can see what we're seeing here is a little bit of a different picture. As we just talked about with the March contract, the April contract remains within this upward trending linear regression channel. But again, it's hovering near the -1 standard deviation from the linear regression line. But the Brent, the spot April Brent contract, a little bit more concerning from a technical perspective, a little bit more concerning from a fundamental perspective. And when you look at the technicals, all these technicals are suggesting potentially lower prices here. And again, what we're seeing is this contribution of Brent continuing to depreciate versus WTI, and thus we're seeing that very key spread continuing to narrow. If we look at that April Brent WTI spread, I mean, the April Brent WTI spread, as we all know, not only is it one of the most widely traded spreads in the oil complex, but it's also used as an indicator for many aspects of oil. One of the foremost indicators right now is this is a measure of the economics of exporting crude oil. You know, if WTI, the premium of Brent, continues to depreciate versus WTI. Look, we were over here at around 6.25 at the end of last year, and now we're around 3.30 a barrel at this point in time. So the spread has depreciated by about $3 a barrel, which if you're an exporter of crude oil from the United States and you're playing that arbitrage, you're making $3 a barrel less today or something in that vicinity than you were making at the end of the year. So this is actually a very concerning movement, and it looks like we're at the bottom again of the linear regression downward trending line, suggesting that the spread could narrow further. And as we approach what's starting to look like the transition period for oil, refinery runs are starting to come down. We're not too far away from the advent of the spring maintenance season, and imports have been rising in the United States. So we may start seeing crude oil starting to increase and adding further pressure to export. And if the spread doesn't warrant the exporting, then we could find that we might see a different evolution. But that said, if crude oil start building in the United States, that certainly should put pressure on WTI. If we don't see any material changes from the international side of the equation, then maybe we could see a bounce in the spread and resume better economics for exporting crude oil from the United States. Just taking another look at the Brent WTI spread. This chart shows the 5-year average. Certainly, we have a little bit of seasonality where we tend to narrow during the spring and summer months. But this spread now is well below the 5-year average, and it's actually closer to the 5-year minimum. What is the 5-year minimum? Meaning the lowest level hit for that week during the 5-year period. And obviously, it's well off of the 5-year highs hit probably 5 years ago, the way the spread's been trading. So, again, concerning. Could we continue to trend down? Potentially. If we continue to trend down, we're going to get to a point in time where the economics of exporting could start becoming marginal. And if they do, that could be obviously a very bearish sign for oil, because it could push oil prices down. It could change the forward market structure to away from a backwardation back towards a bit of a contango, and we could start seeing inventories building along the way. And we'll talk a little bit more about that when we get into the fundamental charts of the week. So let's take with the products. And again, if we look at the products, I'm not very excited about these products right now. I mean, I guess the most important thing that I can say that's supportive of both the diesel and the gasoline is inventories came down last week. Maybe inventories might start coming off a bit here as refinery runs continue to go down, as we start working our way towards the maintenance season. But the March ultra low sulfur diesel contract, that's been probing below the 1 standard deviation line of the linear regression. The technical indicators all suggest lower prices. Gasoline is even less exciting, and that's clearly now trading below the channel. That's broken out to the downside. So I'd have to suggest that if we have to take a bias here, I'd put gasoline to the downside, and if we're going to go taking a position, I would be looking at a window maybe short term to take a short position. I mean, I think longer term, as we'll talk about later, we should resume this uptrend. But in the short term, we could still see lower prices here. That would not surprise me in the least right now. If we look at the crack spreads, again, they're not really performing very well, considering refinery runs in the United States are below 90% right now. And again, the ultra low sulfur diesel contract seems to be narrowing at an even steeper rate than the gasoline contract, and that's part of the warming pattern that's coming. So we have to be a little bit concerning here. I like looking for a window to get long some of these crack spreads, because as we approach the maintenance season, as refinery runs continue to go down, we should see product inventory starting to decline, and both diesel and gasoline inventories are lower than both last year and the 5-year average. So if that trend moves into a destocking into the refined product side of the equation, we could start seeing some of these spreads recover. So this is an area that I'd say watch, put it on your radar, and there may be a window. But in the short term, we certainly could see these spreads come down a little bit further here before they start stabilizing. The externals, remember I said last week, the externals are starting to play a role. Well, the externals really took over last week. Yes, we had some bearish weekly inventory data, but it really was the direction of the dollar and the direction of equities that really took front and center stage here. The dollar index kind of corrected a little bit, moved to the upside, but that's not after falling strongly, and the net result is we saw crude rising, and then towards the end of the week, with the dollar recovering, we saw that correlation going on. So the dollar correlation is there. It's still working. It's still well in place, and it's something we need to be looking at very closely. Um, one of the things happening on the external side of the market is we kind of may be entering this world again, and we haven't been there for several years, but this world again of when things are good, it's starting to become a negative. We saw a relatively good jobs data in the United States, 200,000 new jobs created, unemployment rate staying at 4.1%, and the wages rising. Good news, says the economy's rising. We also saw a relatively high projection by the Atlanta Federal Reserve Bank for GDP for the first quarter. So all signs are looking very, very positive. This morning we saw the European economy growing faster than anticipated. So it looks like the global economy is really continuing to push higher. Well, that's all good news, except if you put your head into the central bank. So good news, and if you get too much good news, it's starting to potentially reflect the exposure for inflation. So interest rates have been creeping up. The concept of maybe the Fed getting U.S. Fed and maybe the ECB getting a little bit more aggressive than anticipated becomes a little bit of a negative for equities, a little bit of a positive for the direction of the dollar versus the main currency pairs, and the net result is it has a negative impact on the direction of crude oil. If we look at the S&P, we've seen such a huge meteoric rise in equities here over the last year, and certainly oil has been following as it's directionally proportional. We're seeing a little bit of a correction now, and certainly oil is coming off in that direction. Do I think this is the beginning of a big bear market in equities? No, I don't. Do I think we're in a correction? Yes, I do. Do I think the correction might have a little bit further to go? Yes, I do. But I think all signs look very good. As I said, the economy looks very good. Corporations are making very, very, very nice profits. Not only are they beating on the profit side during this current earnings season, but they're beating on the top side, on the revenue end of it. And really, when we really look at it, yes, interest rates are going to go up. We know that. The market knows that. But even with interest rates rising, short-term interest rates rising, we're still significantly below where we were when we were at 8-9% interest rate. So I think it's a little bit more of a psychological thing right now. I think it's a little bit more of people, institutions, funds, booking profits. And I think, again, medium term, I still look at a window to buy here. I think there's still more to go in these markets. Going back to the dollar, just to update this from last week, you could see what the implications are on OPEC. Not a big change from last week. In fact, with the dollar rising, if you recall from last week's number, we depreciated about 11.6%. That improved a little bit, albeit as of Friday, the dollar indexed adjusted OPEC basket price is still about 11% below the U.S. dollar basket price, or about $7.33 a barrel of purchasing power depreciation. So OPEC's not out of the woods yet. The dollar is corrected a little bit. We'll have to see how much further that correction takes us right now, but not a big change from last week. A marginal improvement for OPEC's purchasing power, but one that's still a negative from where we're going. If I stay with the main fundamental chart of the week, I have to stay with crude oil in the United States. We saw crude oil bump up again in last week's EIA report to 9.919 million barrels a day. We're far above the average annual Peak hit in 1970 of 9.637 million barrels a day. And now we're just 94,000 barrels a day below the record peak for the month hit in October of 1970. Last week, latter part of last week, the EIA did update their monthly oil production report, and that showed in November we actually did get up to 10 million and 3 million barrels a day. Not at that record peak, but we're quickly approaching it. We're about 11.5% above the year ago average, and all signs continue to show that we're going to rise further. Oil rigs, as I'll touch on in a minute, increased for the second week in a row here. And what's the net result is crude oil's going up. That's concerning a bit for OPEC, but also this is something we need to pay attention now. Total combined stocks of crude oil and refined products increased last week. We're entering a period where seasonally these inventories tend to increase. The negative that exists is the market is in a backwardation, so we'll have to see how this all plays out. But this is a caution flag. This is a caution flag that could have a negative implication on the overall price of crude oil here in the short term. Not so much the long term, but in the short term, I'd be concerned a little bit. Refinery runs are still coming down. We saw another decrease last week. We're below 90%, as you can see down here. We're probably going to remain on the defensive while we enter into this refinery maintenance season. It's very interesting. Crude oil demand is starting to go down because refinery demand is going to go down. So again, you can see the seasonality that we're starting to approach. So after a rather lengthy destocking pattern, we could see some recovery in crude oil inventories here in the next 2, 3, 4, 5 weeks, until which time we start seeing a turnaround after the maintenance season at the end of March, early April. So a transition period, one that takes a little bit of the bullishness out of the market, and one that keeps the caution flag here raised and flying here in the short term. This week's inventories, I'm looking at another build here in crude oil. We had a healthy build last week. I'm expecting a build in gasoline and a small build in distillate fuel. Had a little winter weather last week on the East Coast, so that should have helped the heating oil component of distillate fuel. And I'm expecting refinery runs to continue to drift lower. So kind of a neutral, slightly bearish projection if the inventories turn out to be what I'm projecting here right now. So is the OPEC Accord still working? So far, yes. We're seeing compliance still at high levels. On the other hand, though, as I've already mentioned, that's the big concerning factors. U.S. inventories moved higher last week. Looks like they may move higher again this week. So is this the beginning of the end of the destocking period, at least during the period of the maintenance season? That said, even if they're moving higher right now, we're still starting at a pretty low level. Crude oil stocks after last week's data were still 154.8 million barrels below the high hit in February of 2017, and they're only 33.7 million barrels above the 5-year average. So remember, OPEC is hoping their discipline will get inventories down to that 5-year average. So it still suggests we're going to get there. Maybe not as fast as some are thinking. I know last week we saw Goldman Sachs coming out with their projection and raising crude prices and suggesting that the rebalancing of the oil market is potentially 6 months ahead of itself. I'd like to kind of look at that as we evolve through the destocking pattern. So it could very well be, and we could very well see a relatively shallow short-term downside correction in prices here. OPEC countries are still at a high level of compliance. That's key, and that's what we want to work and pay attention. That's what we want to pay attention to here in the coming weeks as we see projections coming from the various agencies. On the concern side, rigs, U.S. drilling rigs deployed to the oil sector increased for the second week in a row. This week, 6 weeks. The previous week was 12 rigs. So it's 18 rigs in the last 2 weeks. Yeah, it's a little bit bearish. We may have, I thought we might have seen a topping of an increase in rigs, but not so much. We have to watch. Production is now 282,000 barrels a day. I love above the annual record high average from 1970. And as I said before, it's only 94,000 barrels a day below the record monthly high hit in October of 1970. And right now, crude production is about 11.5% above where it was a year ago. So clearly, if crude oil production continues to rise, we're going to just set new records this year. This is going to be a new record-setting year. We're going to be well above the 10 million barrel a day mark, and it's just going to put 2018 into the history books, and 1970 is going to be kind of second in the history book. So, got to keep OPEC on their toes. Got to keep OPEC concerned because at the end of the day, as each new increment of U.S. crude oil goes up, that's another level of market share that OPEC's losing, and we'll have to see. We'll have to see how that sentiment evolves within OPEC as we go forward. Temperature-wise, not looking so positive. This is the NOAA, National Oceanic and Atmospheric Administration forecast from Sunday afternoon. And the concerning factor for heating oil is this part of the map. This is the main heating oil area of the United States, and you see a lot of oranges and some reds coming in. Simply put, that's warmer than normal for this time of the year. Warmer than normal for this time of the year means heating oil demand, propane demand, and even natural gas demand is going to be below normal, and that's going to have a negative impact on inventories. We might not see winter draws continuing here over the next 2-3 weeks. And this kind of puts us into the beginning of the second half of February. So we have to watch this very closely. This is a bearish forecast for heating oil. It's a bearish forecast for natural gas. It's a bearish forecast for propane. So where are we this week? I think it's going to be an exciting week. I think it's going to be a volatile week. You have to keep more than one eye on how equities are trading. You have to keep more than one eye on how the dollar's going. OPEC is still saying the right things. OPEC's committed. We're going to start this round of monthly forecasts, which does impact the market. The EIA is kicking it off with their short-term energy outlook report. The STIO report comes out about noon Eastern time tomorrow. Obviously, the market's going to look very, very, very closely at the EIA's forecast for the next 12 months or so into early 2019 for crude oil production and see where that lands. Certainly going to look at the EIA's total global supply and demand balances. The EIA data, I expect them to show probably a pretty noticeable increase in crude oil production tomorrow, which I think will be bearish. And I think that they'll probably show OECD inventory still through 2018 coming in at the higher end of normal or the 5-year envelope. The following Monday on the 12th, we'll see OPEC's projection followed on Tuesday morning early by the International Energy Agency or the IEA. The OPEC production, the IEA production, especially the IEA production, we're going to look very, very closely at global demand and obviously what's happening internationally and how much. We're starting to see last week a couple of interesting announcements. That's a little bit negative, not in the short term, but certainly different than what we've seen over the last couple of years. We saw a pretty big find announced by Chevron in the eastern Gulf of Mexico. That's a consortium of Exxon and Total, and certainly that doesn't encourage OPEC. And we also saw an announcement up in the North Sea of an increase in Brent production, North Sea production, I should say. Money is being spent. CapEx budgets are going into some of these uh, drilling endeavors that were kind of on the back burner here for a while. And also we saw how real it turns out to be. There's a bunch of politics going on in Mexico right now because we have election for president. I believe it's in June. But the auction for the offshore drilling garnered about $100 million last week. So very positive and very encouraging for Mexico. Now, the one candidate who's running for president over there said he's going to challenge all of those and audit them and make sure it's not uh, soft numbers. So we'll see what's going on. There's a lot of politics in Mexico right now. But just those three items is suggesting to me that the oil industry is getting a little bit more comfortable with price levels and also, I mean, I don't show you a slide here, but uh, there's more hedging going on by the shale producers, and we're in that mid $60 TI price. We're as high as $71 for Brent. So producers are starting to mitigate some of the risk, which means that production is going to continue to rise. So we'll have to see if the global economy does in fact continue to be robust, like we're starting to see some of the early leading indicators, and certainly if the central banks don't put too much of a damper on what's going on. So let's pay attention to those reports starting tomorrow afternoon. Keep a close eye on the externals. Let's watch those equity markets in particular, and certainly the direction of the dollar. The market sentiment drifted because of the global equity markets taking a pretty good hit last week, and the U.S. dollar increasing. So what did we see last week? We saw the overbought indicators, RSIs, percent Rs, basically receding. The RSI, 14-day RSI, is down to in the 60s, which is a lot more comfortable. The commitment of traders report certainly saw some of the long side traders moving to the sideline. So the trade is still crowded to the upside, but not nearly as crowded as it was. So again, that's a good sign for the bulls. We want to get some room in there so we can certainly get back to bringing in Lent here and people starting to get long for another round. And again, we have to watch this. This could slow things up in the short term. So when we look at where we are with the medium term, I still think that we're going to get higher prices. I still believe we're going to get higher prices, but I'm still cautious. I wouldn't be running out today buying a whole lot of oil. And in fact, you might even have gotten yourself a little bit short with this move to the downside. And if you did, I'd run with very tight stops here along the way. So right now, I'm kind of more of a view standing aside. If anything, I traded very, very, very short term from very selective short side trades. I wouldn't put a lot of risk in that. And really, my interest is looking for a window of opportunity to reset longs. I think that window is going to come, and our signals may come from the external markets. Another caution flag is that Brent WTI spread. It's narrowed by around $3 a barrel since peaking at the end of 2017. The export or the economics of exporting U.S. crude is becoming much less economical, and with production rising and refinery demand starting to slow, something's got to give here. Either WTI is going to start depreciating versus Brent so as to not back up this crude, especially with crude being in a backwardation. And obviously, if the spread widens out further, we'll see a further uptick in exports going on. So again, pay attention to that spread. It's going to be key to some of the balances as we look here in the next week, 2 weeks, 3 weeks. Any kind of long trades in any of the asset classes, use trailing stops. It's volatile right now. We're going to get some, the market's jumpy. Last week was a jumpy week, so you got a lot of nervousness coming into the market. The diesel gasoline spread I'm kind of neutral to almost a little bit on the short side. I don't like those charts. We'll have to see what happens here in the next couple of days with the weather charts, but the weather charts are bearish for heating oil, and gasoline inventories are certainly not hurting at the moment. So it's almost, I just don't see a high risk reward for this particular spread right now. So I'd be more inclined to stay to the sidelines. The crack spreads, I'm a little bit surprised they continue to depreciate the way they've been depreciating, especially with refinery runs now below 90% level. But it looks like from a technical perspective, as we saw from those charts, that we may still have some downside potential there. So again, if you're aggressive, you might want to short it. If I was shorting it, I'd short the diesel spread, the diesel crack. But again, much like the outrights, I'd be looking for a window to get long as we get into the heart of the refining session, the refining maintenance session. And again, probably the highest risk reward trade for the cracks at the moment is simply being on the sidelines. So I hope you have a great, profitable, successful, and exciting week of trading this week. I know I will, and I know the markets are going to present us with a whole lot of opportunities. I hope I've pointed you in the right direction to look at some of the opportunities. If you have any questions, please feel free to contact me. It says Dominic Chiricella, and my email is dchiricella at emi.org. You can go to our website at www.emi.org to subscribe to our publication, to take a further trial rate, and hopefully we'll see you again next week. And also keep coming back, because we're also going to do a similar report on Mondays or Tuesdays on the natural gas side, natural gas LNG side of the market. So success in trading this week, and I hope you are very profitable.